There is a silent operating system running in the background of your life, a financial framework that the wealthy understand intimately but you were never meant to see. Most people spend their lives being steered away from this information, working 3 to 4 months every year just to pay a tax bill that the wealthy have found a way to bypass legally. But once you see it, you can't unsee it. We've been taught to believe that hard work and a high salary are the only paths to wealth. But the truth is, workers and owners play by two fundamentally different sets of rules. The tax code wasn't designed for the person receiving the paycheck. It was designed to reward the person signing it. The minute you cross that line, even if it's with just one rental property, you are suddenly playing a completely different game. Today, I am giving you the owner's playbook. I'm going to show you the fundamental, almost invisible system that the wealthy use to not just get rich, but to stay rich forever and to compound that wealth beyond what most people could ever imagine possible. When you combine this playbook with a specific twist in the tax code, you unlock what I call the Zero Tax Snowball. This is a system that lets your wealth compound faster than the IRS can tax it. If you've ever felt like you're working 3 to 4 months a year just to cover your tax bill, this video is the information access you've been missing. Most people are stuck on an endless treadmill designed to keep them generating income, only to have a significant portion siphoned off by Uncle Sam. This is a system that lets your wealth compound faster than the IRS can tax it. Let's look at where the crucial mindset shift actually happens. Imagine you buy a property, a nice single-family home. It produces a bit of cash flow, maybe $300 a month. More importantly, it offers depreciation. The IRS allows you to deduct a portion of its value each year as if it's wearing out, even if it's brand new. But here is where the 9-to-5 worker mindset takes over. Let's say you bought that house for $400,000. A few years pass and it appreciates to $500,000. The average person thinks, wow, I've made $100,000. I should sell now and cash in on that profit. And they do. They sell the house. They get their $100,000 profit. But then Uncle Sam comes knocking because that $100,000 is a capital gain. Depending on your income, the government is going to take 15% or 20%. That $100,000 profit quickly becomes $80,000 or $85,000. You pay your taxes, you feel the sting, and now you have a pile of cash, but you've lost your asset. Your wealth journey has hit a reset button. You're playing a game where every time you score, the referee takes a cut and sends you right back to the starting line. Wealthy people understand that selling equals taxation. So, here is how a truly wealthy person would approach that same $500,000 house. They wouldn't sell it. Instead, they would borrow against it. The key here is understanding a fundamental truth that the IRS does not want you to focus on. Borrowed money is not income. Because it is debt, it is not taxed. Let's look at the math. You bought the house for $400,000 with a $320,000 mortgage. Over the years, your tenants helped pay down that mortgage to $280,000, while the house appreciated to $500,000. Most lenders will allow you to borrow up to 75% of that new value through what's called a cash-out refinance. 75% of $500,000 is $375,000, and $375,000 reduced $280,000 equals $95,000 in tax-free cash. That is money flowing into your bank account, completely untouched by the IRS. Wealthy people don't fear debt, they fear taxable events. Debt is simply the bridge that lets your assets keep working while your taxes stay low. As long as the assets pay for the debt, it's a tool, not a threat. This is exactly why billionaires like Mark Zuckerberg and Elon Musk famously take a $1 salary. They don't need income because they have billions in company stock. They borrow against that stock to fund their lives and ventures rather than selling and incurring massive tax bills. This is a relentless compounding cycle. Buy, grow, borrow, buy again. You build a larger and larger portfolio of assets that cash flow, provide deductions, and appreciate, all without ever triggering a taxable event by selling. This is called the borrow until you die strategy. But the true magic happens when you do die. When heirs inherit these assets, the stocks and the real estate, they get a full step up in basis. This means if the heirs decide to sell, they owe nothing on decades of gains. The snowball keeps rolling, transferring wealth across generations and avoiding the tax reset button at every turn. It isn't illegal, it's worse. It's allowed. It is a system designed to keep wealth within families, compounding generation after generation, completely legally and ethically. For a long time, this felt exclusive to the ultra-rich. The everyday worker was left on the outside, stuck in a paradigm of earn, get taxed, spend. But something changed. A massive, messy piece of legislation, the Big Beautiful Bill, delivered a supercharger for the average W-2 earner. Real estate is the one true vehicle that anyone can use to sneak into this wealth-building club. It doesn't require billions in stock options. It just requires understanding the playbook. The secret weapon for W-2 earners is the short-term rental (STR) loophole. If you own an Airbnb and materially participate in managing it, treating it like an active business, the IRS doesn't treat it like a typical rental. This distinction changes everything. When you actively manage your STR, the paper losses created by bonus depreciation can offset your day job income. Bonus depreciation is not a minor tax break. It is the ability to take years, even decades, of tax write-offs and apply them in year one. Instead of slowly depreciating a property over 39 years, the government essentially lets you take a massive chunk of your W-2 income and make it disappear on paper. Conceptually, the government is giving you a tax-free loan. You use that capital to acquire more assets to fuel your wealth snowball and start playing the borrow until you die game. Let's walk through the exact blueprint for a typical W-2 worker earning a $100,000 salary. Usually, this person owes between $18,000 and $22,000 in annual taxes. Now, imagine you acquire a $500,000 short-term rental property. You manage it yourself and get a cost segregation study done to maximize your bonus depreciation. A rough rule of thumb is that you can generate a paper loss of about 25% of the property's value. In this case, that's a $125,000 paper loss in year one. Thanks to the STR loophole, that $125,000 offsets your $100,000 W-2 income. Your taxable income equals $0. Tax bill will be eliminated. You even have an extra $25,000 loss to carry forward into the next year to keep reducing your burden. Instead of saying goodbye to that $20,000, you retain it in your possession. What do you do with that $20,000? You strategically deploy it. You use that tax-free capital combined with the cash flow from your first property as the down payment for your second asset. That second rental, if you manage it actively, also qualifies for bonus depreciation, generating more losses to offset more income. This is when your snowball begins. These are the rules the wealthy live by. First, cash flow grows equity. Equity unlocks borrowing tax-free. Borrowed capital buys more assets. More assets create more deductions via bonus depreciation. More deductions eliminate taxes. Eliminated taxes mean more deployable capital to acquire even more assets. That is the Zero Tax Snowball. It is the engine of the wealthy. It isn't about intelligence or how hard you work. It's about access to the information and the strategy. You can stay on the treadmill, or you can cross the line and become an owner.